With the stock market pushing all-time highs, the interesting thing is there are a lot of value names selling off. In this video, we're going to talk through a few different names trading at 52-week lows, and we're going to give you 2025 price targets. I don't want to waste your time. I don't want to sell you anything. And once again, this is not financial advice. This is just my opinion, but let's get into stock number one. Stock number one recently hit a high of $133 a share and has sold off drastically down near 40%, which is now putting it in extreme value territory, trading at 12 times earnings, which is half of what the S&P 500 is trading for, and paying nearly a 4% dividend. Once again, tripling up what the S&P 500 dividend is paying. And the stock we are talking about is Merck, ticker symbol MRK. Now, Merck has steadily grown its revenue and earnings are following as well. So this sell-off is actually giving an interesting opportunity because this is one of the cheapest valuations we've seen on Merck in a long time. With a forward PE trading at 9 times earnings, and most people's price targets coming in with a buy with nearly 40% upside, basically regaining that recent sell-off, we can see here there could be some pretty good opportunity here in Merck. We even have as high as price targets as $155 a share, nearly doubling where it's almost sitting right now. Now, Schwab gives it a C rating. Morningstar gives it a 3-star rating, meaning it could be a market outperformer. So overall, I would say sentiment is pretty neutral to positive, especially at these levels. Morningstar believes that it's sitting closer to at about $111 stock. Now, when we look at valuation compared to their peers, we can see Merck is definitely trading at almost a 50% discount to its peers. And over the last 35 years, Merck has paid a dividend, and over the last 14 years, they have raised this dividend, which makes it a dividend compounder. Now, going through Merck's fourth quarter results here, I was actually impressed with the fact that they increased revenue by 7%. And from impact of foreign exchange, it was actually 9%. They're giving us pretty clear guidance here of $64.1 billion in revenue to about $65.6 billion of revenue, with EPS coming in right around $9 a share, which means it's trading, as we saw, for less than 10 times earnings. Now, we just saw they are guiding for around 64 to 65 billion in revenue, and we could see that Street was looking for 67.8 billion with growth going forward, and EPS following very, very strong here. Now, we're going to plug in our numbers using their updated fourth quarter analysis to get an ideal price target. I'm basically meeting in the middle and saying that the company is going to grow between 4 and 3% going forward. They guided for 64 to 65 billion. I'm meeting right there at 64.8 billion of revenue and growing steadily at 4%. Now, because a large part of our returns is going to come in the form of a dividend of nearly 4%, we don't need a huge required rate of return here because they've shown to actually be very reliable with that dividend. And I don't think the dividend is in jeopardy right now with the recent growth rates that they've displayed. So for that reason, I'm only going to require around a 7%, because if we topple in nearly a 4% dividend, that's going to get us a double-digit rate of return going forward. And we get an ideal stock price sitting right around $76 a share and $85 a share from a free cash flow standpoint. So I feel like anything between $75 to $85 makes a tremendous amount of sense for a company like Merck. You can see here we have a future value of $139 to about $140 a share. As we saw earlier, this stock did hit the 130s, so this is very realistic. I think it's very feasible that you can reinvest this dividend and be looking at a $140 stock in the near future. Before we get to our next stock, I do just want to hit on Pfizer really quick since we talked about Merck. Pfizer's down over 56% from the COVID highs and now trading at a historically low valuation, which now it's yielding a 6.74% dividend. Now, the concern everybody has is the patent cliff that Pfizer is facing here. But they have 32 products in phase 3 development, 5 that are for registration, and they have a tremendous amount of cost initiatives going forward, which makes me think that this could be a buying opportunity with some risk, obviously. So I'm going to keep my $24 to $25 price target on Pfizer. We're not going to do anything quite yet. Schwab gives it a C rating, a market perform. Morningstar is very, very bullish on this company, giving it a wide moat, and the fact that they have mass scalability, which is now going to lead to one of our darlings here of Pepsi. This is usually a safe haven for sure and a dividend lover. Down 20% over the last year, hit a high of over $180 a share, and is now trading around $143. which is giving it a 20 PE ratio and a dividend yield of over 3.75%. Now, Pepsi definitely dealt with some interesting headwinds that Coca-Cola did not, and that's why we're seeing the divergence between Pepsi and Coke. We can see that over the last 5 years, the nice steady increase of Coca-Cola here, and now the recent pop, it looks like it definitely wants to break out to newer highs. breaking out above $72.50. Now we layer that with Pepsi and we can see that the performance has been pretty steadily intact. There was a pretty big divergence taking place here on June and July, but now we're starting to see Coca-Cola outperform and Pepsi underperform, which could lend a buying opportunity here. Now, Pepsi usually trades for a premium because of their packaged foods and the strength of their ability to pass on inflation to consumers, but the problem really lies with packaged foods, with RFK getting in office and packaged foods kind of having some serious headwinds here with inflation. Pepsi's not alone and is getting hammered. They were impacted by foreign exchange, having a strong dollar. So the things I want to highlight here is they had recalls in their Quaker Foods North America division. They had disruptions due to geopolitical tension and uncertainty with international markets. And all these things could actually get reversed and surprise to the upside for Pepsi. If we see the dollar weaken and we see packaged foods maybe not get hit as hard, with Frito-Lay's operating profit decreasing by 11%, a big part of this was dealing with operating cost increases. I would say overall, it was kind of a choppy year for Pepsi, and we're seeing that reflected in the price, but I don't know if this is long-term problems here. I actually think that this could be turned around, especially when you got management like Pepsi and a footprint like Pepsi. When we take a look at sentiment around Pepsi, we have a low of $150, a high of $200, and it's trading just below that at $143. Stock analysis has them growing a little over 3%. Schwab rates this as a C rating, actually below both Merck and Pfizer with a 61 rating. Morningstar gives it a 4-star rating. CFRA gives it a 4-star rating. So everybody's pretty neutral on this one, which tells me from where the experts are sitting, I would probably wait for this to fall just a little bit more. The thing I would definitely be concerned about is the dividend payout ratio as of right now. Now, just to reiterate, this is a company that has paid a dividend for 52 years and has grown those dividends for 52 consecutive years, and they plan on raising this dividend as they stated in their earnings. So as of right now, they're definitely going to keep paying that dividend regardless of how it impacts the company, it seems. I think if they stop paying the dividend, it would cause a massive sell-off in the stock, and so they're going to do everything they can at this point in time, with so many people relying on this dividend for income, to keep paying that dividend. So with that said, I'm using 3% growth rates just to be safe. My required rate of return is going to be 7%. Multiple reasons why. This has a wide moat. If I build too much safety in this name, I'm probably never going to get filled. And the other thing is the dividend has been reliable for 52 years. So we do want to incorporate that into total returns. So that over 3% dividend does give me a double-digit rate of return toppled with a 7% required rate of return, which then gives us an ideal stock price sitting around 120, between 120 and 130. Obviously, we put a little buffer in there, we could be looking closer to 115, which is leading to our next stock that is in an absolute free fall as well, and that is going to be Lockheed Martin, ticker symbol LMT. Now, I'm not so sure the selling is quite done on this one because it's in free fall, and there is concern that defense spending could get cut here, and we have insider selling in Lockheed Martin, which is usually never a good sign. Now, that being said, I do think you're going to have a tremendous opportunity to buy a very, very quality, safe company at the right price, and we're going to get into that 1 minute. But this recent sell-off has led to a PE ratio sitting around 19 times and paying now a 3% dividend due to that sell-off. Schwab gives it a C rating. Nothing new there. Schwab doesn't like a lot of different names here that have a political negativity attached to it, whether that's pharmaceuticals, whether that's packaged foods, and now obviously government spending could be getting cut. So Schwab is very, very conservative with their analysis, so this needs to fall a little bit more for Schwab to give it an outperformance. Morningstar gives it a 4-star rating with a wide moat. Now, Morningstar believes this could be a $530 stock. We have a low of $497, a high of $635. If you want to talk about mixed feelings on a stock, I think Lockheed Martin hits all cylinders on this one. Now, they have a very, very strong backlog. They are still getting some nice contracts. When we talk about one of the more important companies in the world, trading out of forward PE sitting at 15, 16 times, while industry sitting at 22 times, I definitely think there could be an opportunity here for Lockheed Martin. Dividend safety sitting around 57%. Would like to see that a little bit lower, but they've been paying that dividend for 29 years and growing that dividend for the last 22 consecutive years. So once again, dividend compounder. Now, for me personally, I'm using 2% growth rates over the next 3 years. I do think there's going to be cuts here, but I also think that they still are going to be able to grow revenue slightly. After that, I do think we're going to see fiscal spending pick up, and I would be leaning more on the multiple to EBITDA for the price target here of $380 a share. That's where I get interested in this stock. Now, I just want to go through 2 bonus names before I end this video, and it's going to be Hormel Foods. This is one I've done analysis on, and I've warned people that the valuation on this company has been outrageous. When you factor in a company that keeps raising their dividend, but is not growing their earnings or free cash flow, you end up running into a pretty significant problem here. This stock was over $36 a share and is now trading at $28 a share, down 22.6%. So no matter how many dividends you received, you are down in this position. Now, trading at 19 times earnings after the sell-off and getting over a 4% dividend yield, I do think it might be getting a little bit interesting at these levels, but I don't think you're getting a deal here. And this is the concern I have. As they keep raising the dividend every year, we're starting to see revenue flatten out, and we're seeing EPS kind of go nowhere. We have forecasters with a low of 28 and a high of 36. And if we look at their growth rates, they're basically keeping up with inflation. Now, Schwab and Morningstar are not impressed with this company, basically putting a market performance on it. Morningstar giving it right around a $31 price target. So from these levels, actually, you do have some upside here. So I'm sure if Morningstar updated this one, it might be a little bit closer to a market outperformer because that 4% dividend and 10-11% upside in the stock. Now, I did this analysis a while back and I got an ideal price target sitting around $23 to about $26 a share. And as you guys can see right now, it's starting to approach these levels. But what I just want to do is touch up on my analysis here. So the one thing I would just say here is be careful of this dividend payout ratio. You know, it seems to be fairly safe. So this 4% yield could actually be, fairly safe going forward. They've paid this dividend for 58 years, grew the dividend for 58 years, which is extremely impressive, but the stock price has actually remained pretty stagnant to down. So with that being said, I'm sticking to a $26 price target on Hormel Foods. Factoring in a 4% dividend yield, I do believe you can get a double-digit rate of return at these levels, which is going to lead us to SJM Smuckers, another packaged food, and owns the market share of at-home coffee brewing. After this recent sell-off, we see an additional 4% yield, actually over a 4% yield, sitting at 4.23% and trading at 20 times earnings. We're seeing some selling on the name here, and I do think we could see it go lower. With coffee costs going up, as I stated, this is one of the largest at-home coffee producers. Schwab gives it a C rating, Morningstar gives it a 4-star rating, so basically a neutral rating at this point in time. Personally, I have a $91 ideal stock price, so I'm waiting for it to break below $100 a share, and it definitely could happen. It's been floating with $100 a share, and we could see a hard break on this name and maybe even see it approach the $80 range. Once again, this is a company that's paid a dividend for 24 years, has grown those dividends for 24 years, but I just want to touch on Smuckers. And they report earnings on the 27th with 12 analysts actually putting downgrades on those earnings. So this is going to be an interesting one to watch. I do think if we get a pretty big washout on this name, I'd be interested to pick up some shares of Smuckers for longer term. I think this is a company that's going to be just fine. So as always, guys, wanted to update you on those names for 2025 price targets, and we will see you all in the next one.